Welcome to your essential business briefing. More than $8 trillion have been pumped into the global economy during the coronavirus crisis, as governments and central banks do their best to limit the long-term damage. The scale of the support is, in many cases, unprecedented. But is the money going to the right place? And will it help to save jobs and the economy? To discuss this further, I'm joined by Gilles Moec, Group Chief Economist at Axa. Gilles, thanks for being with us. Can I ask you, first of all, are governments getting this right in general? Are we seeing the right sort of steps being put in place that will limit the economic pain?
Yes, I definitely think so. I think that we find some very similar policies actually across the globe. I would say that goal number one is to avoid businesses to just disappear as a consequence of this pandemic, of the lockdowns, and almost all advanced economy, at least, has provided massive support to businesses via guaranteeing loans, for instance. It's intermediated by the banks, but the risk-taking is actually from the governments. That is key. Where countries did not actually already have in place systems such as in-work unemployment benefits, this already existed in France or in Germany, it didn't in the US or in the UK. They created those systems very quickly to avoid getting millions of workers getting completely detached from their companies. That's also very, very positive. And what is probably still missing, but we have a bit of time, is what happens once we are past the peak of the pandemic. Once we exit from lockdowns, we start normalizing. My guess is that we'll still need some fiscal support, but this fiscal support still needs to be designed at this stage.
So there are tens of millions of workers now on these government support schemes. Will they all go back to work when the lockdown is lifted?
Well, we don't know. That's the big issue. It depends on many things. First, how detached they're going to be from their employer. This is where I think the European approach is probably more efficient, touch wood, in the sense that we are providing support to workers who are still in a contractual relationship with their employer. So when the economy normalizes, when activity normalizes, in principle at least, these people will simply go back to work and nothing will have changed. In some countries, it's also the case in the US, in many cases, companies actually had to sever the contractual relationship with their employees. They will have to make an actual decision after the lockdown on whether or not to rehire these people. So that is one of the risks.
How difficult will it be to wean those businesses off this life support when the lockdown measures are lifted?
It is not going to be easy, and personally, I think that support in the form of state-guaranteed loans will have to last for much longer than just the peak of the crisis. In quite a few cases, those loans were designed in a way which would provide some breathing space to the corporates. For instance, they don't need to repay those loans immediately. They don't need to pay interest on those loans immediately. And in quite a few cases, the interest rate in many cases is very, very low. So this will, to some extent, protect cash flows. But if we assume that we won't find a normalization in activity very quickly, the problem is that we have created debt simply as a substitute to a decline in cash flows. Normally, you take debt because you invest, because you think that thanks to this loan, you're going to be able to produce more and to make more profits in the future. Not this time. This time, we're taking loans simply to plug a hole. And this hole, in some cases, in some sectors, is likely to be permanent. So my impression, actually, I think at least, is that in many cases, we'll have to revise the conditions of those loans. We'll have to make their amortization much longer than what it is today.
Do at this stage we need to worry about how we're going to pay for all this? Because it's a massive amount of money that governments are shelling out.
No, we don't, because the central banks are doing their job. And they clearly learned from the Great Recession of 08-09. They were much quicker in responding to the challenge by, in reality, in fact, funding the governments. It's indirect. They do not provide immediate cash to the governments, but they buy those hundreds of billions of euros or dollars or pounds of government bonds. So we are responding to the crisis. We are funding the response to this crisis by raising the size of the central bank's balance sheet. And at this stage, it is the only actor which can almost infinitely raise the size of its balance sheet. The only problem would be that this would trigger either inflation or a lack of credibility of monetary policy, a doubt as to the quality of money, of currencies. But for now, we're not there, certainly not, because again, what we're doing is that we are substituting public sector money to private sector money, but we're not increasing the overall quantum of spending in the system. Quite the opposite, actually. We are facing recessions. So it cannot be inflationary. We can take the risk of funding the policy response through an inflation of the central bank's balance sheet without taking a risk for consumer prices.
OK, Gilles Moec, Chief Economist at Axa, thank you very much for joining us. Thank you to you for watching at home as well. Get in touch with your questions on the economic impact of the pandemic. You'll find us on social media. Until next time, thanks for watching.